Welcome, and thank you for joining us today. Today we'll be discussing how to best cope with a volatile market. Please be aware that when it comes to investing, past performance does not guarantee future results. Market volatility is outside your control and can be caused by many different factors. During times of market volatility, it is important not to dwell on the factors outside your control, but instead focus on areas you can control to help improve your outcomes. Today we'll be discussing how best to manage market volatility and some common mistakes to avoid. Managing market volatility. So what can you do to help manage volatility? You should maintain a long-term perspective instead of focusing on the short-term volatility. You should continue to save and invest regularly. You should ensure you understand what your risk tolerance is and maintain a diversified portfolio, and you should rebalance your portfolio periodically. The first strategy is to maintain a long-term perspective. The most common mistake investors make is trying to time the market. We've all heard the stories of someone getting into a stock right at that perfect time. However, it is extremely hard to do and may lead to significant negative effects if done incorrectly. Generally, the risks greatly outweigh the potential rewards. Market consolidations have happened regularly in well-functioning economies, much like the one we were in at the beginning of the year. These drawdowns are typically short-term and volatile, but during which some of the best days of the market can happen. For example, 75% of the S&P 500's 20 best performing days since 1950 have occurred during downturns in the market. Missing just a few of these best days can have a significant negative impact on your portfolio. For long-term investors, periods of high returns tend to offset periods of low returns. In other words, while returns may fluctuate widely from year to year, holding an asset for longer periods of time results in apparent decreased volatility. For example, someone who invested 50% in stocks and 50% in bonds in their portfolio since 1926 saw a yearly return anywhere from down 43% to up 74%. However, if that same investor held that portfolio for 10 or more years, they never had a 10-year period where their investment lost money. The second key investment strategy is dollar cost averaging. Dollar cost averaging is the process of investing at regular intervals, typically each pay period, over a long period of time. Instead of trying to time the market, you're investing on a regular schedule. That means that you're automatically buying more shares when the prices are lower, and as a result, your average cost per share will be lower. For example, we invest $100 per month into our account. As you can see, the price per share fluctuated over the 6 months, ranging from $10 a share down to $5 a share. When the market went down in March, the $100 purchase bought twice as many shares. Think of this as stocks going on sale. As you can see, although the average cost per share was $8, since we invested the same amount when the stocks were on sale, our price per share was less, giving us instant gains. The third key investment strategy is understanding your risk tolerance and diversification. Asset allocation is how you spread your money across stocks, bonds, and cash. This will set how risky of an investor you are. Generally, the more invested in the stocks you are, the higher level of risk you are taking. Please visit your retirement plan's record keeper's website to access their risk tolerance tools and see what type of investor you are. Diversification is how you spread your investments within each asset class, ensuring that you do not put all of your eggs in one basket. If you are invested in a retirement date fund or a managed account product, this process is automatically done for you. Diversifying your portfolio makes you less dependent on the performance of any single asset class. As you can see, from 2009 to 2018, stocks and bonds had a wide array of returns. Sometimes stocks performed better than bonds, and sometimes bonds performed better than stocks. By not putting all of your investments into just stocks or bonds, you're able to smooth out those volatile returns. The last key investment strategy is to rebalance periodically. Over time, your asset allocation will change because different asset classes produce different rates of return. Imagine this simple example. If your assets are split equally between stocks and bonds, 100 in each, and over the year, your bonds hold steady at 100, but your stocks double in value to 200. While this is great news, you just made 50%. Your allocation will no longer be 50-50. It will now be 2/3 stocks and only 1/3 bonds, with stocks making up much more of the overall portfolio and your account being much riskier. To rebalance, you will move your allocation back to 50% stocks and 50% bonds. This process forces the best practice of buying low and selling high. After the stocks increase in value, you sell them and buy bonds which have not. By following those 4 key investment strategies, you'll be able to better navigate volatile markets. Now let's review some common mistakes you should avoid. Regardless of your current situation, a down market is not the time to make radical changes. Whatever you do, don't just blindly sell your stock funds and move all of your assets. Although the urge to flee to safety can be overpowering, your current losses are all on paper. If you sell now, you lock in those losses. If retirement is still years or decades away, you have time to let your portfolio recover. So what should you do? If you have a long-term investment strategy in place before the markets took a dive, it's time to revisit your plan. Are your goals still the same? Is your retirement still many years in the future? If the particulars of your situation haven't changed, there's no reason to change your investment. Stock prices rise and fall. Just because they have fallen doesn't mean your strategy should change. Again, during times like these, it is important to re-examine your goals, time horizon, and risk tolerance to ensure your current strategy is aimed at reaching your investment goals. Your Retirement Plan Record Keeper's website will have tools and calculators you can use, or you can always contact a professional for further guidance. Thank you so much for joining us today. We hope we have given you some useful strategies you can use during these volatile market times.